Shares of First Republic Bank and some hot water as hopes dim for a rescue deal. CNBC's David Faber reporting earlier today that the regional lender could potentially follow Silicon Valley Bank into FDIC receivership. And the shares plunging today. They've been halted multiple times for volatility, as they have really all week long. Let's talk through the potential implications for FRC and other regional bank investors with Timothy Coffey, Managing Director at Janney Montgomery Scott. Tim, thanks for being here. It has certainly been a wild week here. It seemed like the situation might resolve itself, that the company was going to be successful, maybe at doing some asset sales. I mean, how do you even analyze the thing at this point? It seems like it's pretty opaque what's going on.
Well, first of all, it's not a great day for Bankland. Anytime these things happen, nobody in the industry really feels great about it. That being said, there's been a certain number of challenges for First Republic that have become public since they released earnings on Monday. And one of them is that they need to sell assets. I think we had written a report on Tuesday, saying they need to do the mother of all pivots. And one of the things they need to do was shrink the balance sheet. And what they have on there, not really much of a credit risk, right? We're talking residential mortgages, high net worth people, and government securities. The issue is that the current market value of those assets are lower than when they were originated. And that gap, it shows up as a mark on the loans, and whoever would buy the loans or those securities then has to inherit that gap in their equity. And the issue with that is, in an environment where banks are being encouraged to maintain capital levels or grow capital levels into a potentially softening economic environment, it's a tough pill for a buyer to swallow and take on those loans while fully knowing well that they're going to be lowering their own capital ratios.
Tim, so as we know, CNBC reporting that First Republic likely headed to FDIC receivership. Can First Republic survive?
Well, unless there's an asset sale and a follow-on equity raise to support their own capital levels, make up for the losses that they would incur on the sale of the assets, it's unlikely. It's unlikely. And based on all the reporting, the things I'm hearing as well, that there is that standstill between what First Republic believes they need to sell the assets at in order to survive and what a buyer is willing to buy them at. And so far, they're not closing that gap in a fast enough manner, unfortunately.
What about a potential contagion effect to any other peers within regional banking? What are you seeing?
Well, not much, right? What we saw from coming out of Silicon Valley Bank was a really localized contagion, right? It was localized to the VC and private equity communities. After Silicon Valley Bank was closed on the run of the bank, we saw immediate problems that other banks exposed to that industry: First Republic, PacWest, Western Alliance, and it looks like it's just going to be First Republic that's going to have, unfortunately, the biggest wound from what happened after Silicon Valley Bank. But we're not seeing contagion across the industry. We're certainly seeing some movement of deposits and some higher deposit costs, but that's really reflective of an overall tightening rate environment and tightening money supply. Talking to local banks, because I'm actually in the Bay Area, what they're saying is, they think that it could lead to some additional anxiety from depositors and potentially some taint on these companies because they are in the local market where Silicon Valley Bank and First Republic were headquartered. But they do think it's going to open up more opportunities for their own business to grow.
Yeah, indeed. One of the things that kind of stands out today, Tim, is the fact that the KRE, the regional banking ETF, is actually higher. And with the exception of PacWest, which you mentioned, a lot of the regional banks are getting a lift today also. But PacWest in particular, and I know you said you're on the West Coast, you focus on those West Coast regional banks. Should investors be concerned about something like a PacWest? Are there other banks that have that similar business model to an SVB or to an FRC that investors should be wary of?
Not to a large extent, right? I think those models were different, but the one similarity both First Republic and Silicon Valley Bank had is they grew very, very rapidly in a zero interest rate environment. So they were effectively originating assets at prices that are well below market prices right now, and that's created those negative marks, the negative difference between fair value and carrying value that I discussed earlier.
And then I guess on the flip side of that, are there any regional banks now that you think are particularly attractive? I mean, a lot of them, even though they've bounced back recently, still are pretty beat up for the year to date. So are there others that you think have been unfairly tarred and still are attractive at these levels?
Yes, well, the first one and probably the most obvious one is Western Alliance. We think that bank has, done a fabulous job, being able to bounce back from the deposit outflow they experienced post the closing of Signature Bank, and they've actually grown deposits to date. The business model is suited for a higher rate environment. They're profitable and they're very good on efficiencies. The other bank I think investors should be taking a look at is a bank called Banner Bank out of the Seattle-Tacoma area. They have branches from the Canadian border down to the Mexican border, good granularity in their footprint, good granularity in their deposit base and their loan mix. And I think the one thing that we've learned from the great financial crisis is that concentration kills. And when you've got a bank that has a lot of granularity across every facet of its business, that's probably a bank for the long run.
And so, just real quickly, I'd never heard of that one, so I just looked it up. BANR, that's the ticker on that one, Tim?
Yes.
Okay,
yes.
Cool. Go ahead, Zain.
I want to jump in, Tim. One more question I want to ask you, just about we're doing a lot of postmortems on SVB, Signature Bank, et cetera, and where the responsibility lies. The Fed taking some ownership with regard to that. What do you think is the Fed's responsibility when it comes particularly to First Republic Bank and any further ripple effects?
I think they need to be more attentive to duration risk and interest rate risk. The regulators have, in general, been seeming to operate off of lessons learned in the great financial crisis, which was an asset, a credit quality issue. What we're seeing now is much more of an interest rate risk. Silicon Valley Bank took excessive duration risk in their securities portfolio. First Republic's taken duration risk, excessive duration risk in their loan portfolio. And it's something that the regulators have known about, clearly with the SVB report today, they acknowledge that, but they've done nothing about it. And I think that's a real miss on their part.
Tim, thank you so much. Really great perspective here as we continue to watch those FRC shares go down. Maybe we'll get some more news over the weekend. We'll find out. Timothy Coffey, Managing Director at Janney Montgomery Scott. Thanks.